Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how to account for a goodwill at the date of acquisition, where we make adjustments for fair value of net assets and the related considerations. So let's look at the question. Starting with the requirement, always we look at the requirement. Here, calculate the consolidated goodwill at the date of acquisition of Recast. Again, this is a past question, so I've made an extra from this past question. Now let's see the details. On 1st January 2012, Biadem acquired 90% of the equity share capital of Recast in a share exchange. So, share exchange, in which Biadem issued 2 new shares for every 3. So here the ratio will be 2/3. It acquired in Recast. Additionally, on 31st December, which is 1 year from the acquisition date, Biadem will pay the shareholders of Recast 1.76 per share acquired. The cost of capital is 10%, and this payment is deferred consideration, and it will be the number of shares acquired times the value. At the date of acquisition, the shares in Biadem and Recast had a stock market value of 6.5, and this is what we use for the share exchange, 2.5 respectively. So for Recast 2.5, you have to take note that the NCI value determination, particularly where it is fair value, we have to use the market value if the NCI value is not given. Now, the income statement for the year ended 30th September 2012. So look at it. The acquisition date was 1st January 2012. So reconciling these to the year end, this is 9 months. Very important, 9 months since acquisition. So look at it, we have profit for the year. So for Biadem and Recast, it means that we have to look at the pre-acquisition profit. Because if the year ends 30th September, it means that the year started 1st October 2011. Very important to note that. The start of the year is 1st October 2011. So let's see. Now, the equity balance as at 1st October 2011 for both entities we have for Biadem and Recast. So we need these for the consideration and net asset. And then retained earnings, we need also these for the net assets. Now, the following information. At the date of acquisition, the fair values of Recast net assets were equal to their current amount with the exception of 2 items. So I have here fair value adjustment. Fair value adjustment. An item of plant had a fair value of 1.8 above its current amount. So this is excess. The remaining life of the plant at the date of acquisition was 3 years. And this will be the post-acquisition fair value depreciation. But because we are only concerned with the goodwill at acquisition, this will not be relevant. Depreciation is tied to cost of sales. Now, Recast had a contingent liability which Biadem estimated to have a fair value of 450. This is also fair value adjustment. Now, Recast have not incorporated these fair values changes in its financial statement, and that is expected because it is only in the consolidated account that we account for the fair value adjustment. The next note, Biadem policies to value the non-controlling interest at fair value at the date of acquisition. For this purpose, Recast share price, which we have noticed earlier to be 2.5. So Recast share price at that date can be deemed to be representative of the fair value of non-controlling interest. So let's get this work done quickly. So we have goodwill at acquisition, and this is a question which is the constructed response style or type of question. What do you need? You need a consideration. So the consideration is made up of share exchange. So here we have share exchange, and the share exchange, we have to look at the figure is 90% of the shares, and the share is $1 each, so that is 10 million. So 90% of the 10 million, take note of that. And the exchange ratio is 2/3, and the market price is 6.5. So what we do here is to say 10,000, which is the 10 million number of shares, times 90%, which is 0.9, times the share exchange 2/3, times the market price 6.5. And this should give us, let me put 3 zeros at the top. So that's 9,000 times 2 divided by 3 times 6.5. That should give us 390,000. The next one is the deferred consideration, which is payable a year from the date of acquisition. And that was the number of shares acquired times the price, which is 1.76. So let's see 1.76 quickly. 1.76. However, it is going to be paid 1 year from now, so we have to discount it, and that will be 1/1.1, which is the cost of capital raised to power 1. So let's see the 9,000 times 1.76. That should give me 158,400. Then the discount factor, so 1 divided by 1.1 times 158,400. That should give me 144,000. So the total consideration should be 390 plus 144. So this should be 534. Then I bring in the non-controlling interest. So non-controlling interest. The NCI, their number of shares will be 10% because of the parent percentage of 90 times the share price 2.5 of the subsidiary, and that was given here. Here is it. So quickly let's check that. The 10,000 times 0.1, that's 1,000 times 2.5, that is 2,500. So 2,500. Let me check that. 10,000 times 0.1 times 2.5, $2,500. Now let's check this again. 10,000 times 0.9 times 2 divided by 3 times 6.5. This should be 39,000, not, it should be 39,000. And then the other one, let's see, this times 0.9 times 1.76. So 9,000 times 1.76. This should be 1 15840, and then times 1 divided by 1.1, that should give us 14,400. So it's the number of zeros. Then this should give us 50 plus 39. This should give us 53,400. So plus 2,500, that should give us 55,900. Then we say less net assets at acquisition. The net asset at acquisition, we need a share capital. The share capital was given as 10,000. Then we need the retained earnings. So the retained earnings at 1st October 2011, that was given in a question to be 35,000. So let's bring it here, 35,000. So it's important you always note the zero so you don't get the answer wrong, like I was doing earlier. Then I need a pre-acquisition profit. So it means that I need to count from 1st October, this date, to you have October, November, December, and the acquisition was on the 1st of January. So this is 3 months. So we need 3 months of the current year profit of Greeka. That will be pre-acquisition profit. So 6,200. So let's take that. 6,200 times 3/12. That will give us the pre-acquisition. So 6,200 times 3 divided by 12. That is 1550. So these together will give us the total retained earnings at the date of acquisition. Now we can bring in the fair value adjustments. The fair value adjustment, we had plant and we had contingent liability. So the plant, quickly let's take the value, is 1,800 and the contingent liability is 450,000. So let's get that into the calculation. So this will be 1,800 and this will be 450. So the total net asset would be 10,000 plus 35 plus 1550 plus 1,800 minus 450. That should give us 47,900. From 55,900, that should give us 8,000. So the 8,000 is the goodwill at acquisition. So this is how we account for the goodwill at acquisition. I hope you've been able to learn from this, and this will help you in your preparation for the FR exam. Please subscribe to this channel to receive latest updates on videos.